here. Okay. All right, and let's turn the time over to Lauren.
Okay. Hey, thank you, Randall. Hey, did you get the email that I sent you with the PowerPoint?
Um, I didn't, but I gave you have control so that you can actually share your screen if you like.
Oh, we're going high tech. This will be a first for me on doing a screen share.
Okay, so yeah, if you just click down the bottom and hit the green arrow, hit screen share.
Okay, let's see. Tell me which screen it's showing.
Okay, you have to click on one of them so that it'll show.
Uh, 1 second, guys. Sorry about that.
No worries. And if we have to, I can.
Okay, it's not doing what I want it to do,
All right,
Randall.
no worries. Let me look in here and we'll pull that right up. And Lauren Patterson, PowerPoint. Okay, where's the PowerPoint? Okay, there is no PowerPoint on that email. Let me look here and see. Oh, there we got it. I think I got it. No, is that right? Yeah, okay.
Sorry about that, guys.
It's all right. It's
Information technology. It's a love-hate relationship.
yeah, no, it's all good. All right, let me put it over here and we'll get that up and rolling from the current slide. Okay, and you'll just have to tell me when to go. I'm going to share that screen and admit. Okay, and there we go.
Okay, awesome. There we go. All right. Welcome, everybody. And Randall, as always, thank you for having me. So today we'll talk a little bit about the Fed and their impact on interest rates and the overall economy. And for those of you that have been following, this weekend and the end of last week was a big weekend. Everybody's probably heard about the failure of SVB Bank in Silicon Valley. So we'll touch on that here briefly for a couple minutes and sort of talk about the things that had led up to this one. So we'll do next slide. The next slide is simply an intro on me. Most of you have saw this before, but it wouldn't be a PowerPoint if I didn't put that in there. And then the next screen just simply talks a couple bullet points on working with me as a broker and what we do differently. And next screen talks about pretty much the same thing. I'm going to glance over those just because that is not what this is about. There's much bigger things going on. And I think there's some information that's very important that we're all aware of so that we can also best serve and help clients. Next screen, Randall. So this right here is showing what the 10-year bond has done over since 2000. And the reason that I've got that slide up there is because a lot of people are talking about, will it be a hard landing, a soft landing, and what's the importance of the 10-year with respect to mortgage rates and what's going on in the economy. And as you can see, our 10-year bond dipped to a low between 2020 and 2021, and now it's shot back up. And then we had a little reprieve and it's back up. Well, this morning, the 10-year bond, and we'll talk about this in some greater detail, is now down to 3.4660, which is a massive one-day drop since on Friday we closed just under 4%. The 10-year bond is not directly related or correlating with interest rates, but it does help to give a general direction to the price of interest rates and mortgage-backed securities. Next slide. This will show what's happened since 2018 with respect to interest rates. Everybody's always asking me, where are we at? Are we high? Are we low? What's happening with the market? What do we think is going to happen with the market? Do we see it coming down? This will show you sort of in relative terms what's gone on with interest rates since 2018. And you can see the lows that we saw there back in February of 2021. Right now, we were trending last week, it was just under 7%. In some cases, 30-year fixed rate loans had jumped up above 7% on conventional. This morning, right now, in terms of mortgage-backed security pricing, we're up by 105 basis points. Now, when I say we're up by 105 basis points, That means that pricing has improved by 105 basis points on mortgage-backed securities. 100 basis points is equal to 1% of a loan amount. So think of that in terms of interest rates have come down at least a quarter point overnight, and they've actually come down much more significantly than that, because that 10-year bond is trading right now at 3.4680, which is actually down 22 basis points from where it was at the open today. So there's some really big things happening in the financial markets right now, and there's could be some very good benefits that are going to take place for homeowners and consumers alike. Okay, next slide. This is a lot of talk, and a lot of people have been talking about hard landing, soft landing, where are we really at? This will show you what's happened with inflation since January 2018. And you can see that those numbers, inflation and the numbers are never straight up or straight down. They're peaks and valleys, much like anything else that's trading or that's moving, if you're familiar with watching financial markets. The interesting part about inflation is that those numbers are done on a 12-month rolling basis. So over the next couple of months, and in the months that have just preceded us, you'll hear people talk about inflation is up or inflation is down, and you'll see interest rates go up and you'll see interest rates go down. The reason for that, if you look at those peaks and valleys on that chart, every 12 months, so next month, the 12th month drops off and we pick up a new one. So as you can see, if you happen to be in a month where we hit that low back in January of 2021 or 2020, which is past now, that's going to make inflation look much lower. Okay, now you see where we are now coming out of January 2023, you roll it back to January 2021, and inflation was low, but then when we get to February, look, there's a spike that comes up, and then in March it drops again, and then it goes back up again. So watch for those inflation numbers as we see those coming out in economic forecasts to be moving up and be moving down. The important part about those numbers is that is one of the primary drivers that the Federal Reserve is using up until this weekend to dictate whether they're raising rates and by how much. Okay, right now, Chairman Powell is on a mission to get inflation back under control. He believes it should be under 2%. And so far, okay, now we'll see what happens because they are scheduled for an emergency meeting today at 11 a.m. Eastern. So far, he's been on a path of doing what we call demand destruction, whereby he wants to take out of the economy most every bit of purchasing power that people have, or take the demand out so that inflation will come back down. By taking demand out, the Fed believes that that takes the demand out of supply, it takes the demand out of people wanting goods, and that then brings prices down, which then brings inflation down as well. One of the things that's happened though, and we saw it happen this weekend, is that never before, with the exception of the 70s with Volcker, did the Fed start stepping and moving interest rates as quickly and as much as they have with these most recent moves. Next slide. This, you can see a comparison. Everybody talks about 1970 and how bad inflation was. And for those of us that were around, I remember it kind of. I remember my parents having some rough times through it. So that's the part that I remember. And this shows you the graphs between 1970 and right now. And people are drawing a lot of parallels and comparisons between what happened with inflation in the 70s and what's happening right now. Some people have said, well, we have asked the question, will we see interest rates go up to the levels that they were at in the 70s? I personally don't believe so. Okay. I don't think that that's something that the country can handle. I don't think it's something that we'll see happen. I think that the central banks have also become much more involved in policy, even though they say they're not involved in policy. And so I just personally don't see that happening. But this is an interesting little chart that I thought I would put in there for you folks so that you could see it.
That's
Okay.
nice to be able to see the comparison between then and now, because I'm like you, I can remember, some things being a little bit tough. I can remember houses, going way up, in price or value, with inflation. But that's interesting to see that correlation of then, versus now.
It's kind of crazy when you watch it. And it's interesting when you look at that, it almost mirrors each other identically. Okay. So when we talk about history repeating itself, right, and certain patterns are patterns and that they're there, it almost looks like the Fed is having Groundhog Day. okay, because those moves are moving pretty much in lockstep. So it will be interesting to see what happens going forward, okay? Next slide. This is the one that I get the most oohs and ahs over from people, because everybody's asking where are rates at and how do those compare? And if you've been working with clients who've only come into the housing market in the last couple of years, all they have known are sub 4% interest rates. So with what they're seeing now, they think that their lives have completely ended because we're up around 6, we're up around 7%. And they're looking at this saying, wow, this is the most expensive thing I've ever seen. I'll pull out this chart and charts like this and show them what interest rates have been historically over time. And all of a sudden the discussion gets a little bit better, okay? It puts a relative perspective to things, but you can see what's happening with interest rates over the last 50 years. And that's really the metric that we want to use when we're looking at things. I've always referred to a sort of a 30-year average when I'm talking with clients. A lot of people are looking at it in a much shorter time frame, looking at it from 2018, 2019, 2020. And I think that when we're having discussions, we need to really look at what that 30 to 50-year look back looks like to give us perspective on what's going on with the markets right now. Next slide, Randall. Right now, part of what the Fed is battling, and this becomes an interesting dynamic, is that personal savings in the US have never been lower. We're at almost historic lows with respect to personal savings in the US. What's happening, you hear a lot of people talking about, and the Fed and different politicians are saying that the consumer is in good shape. The economy appears to be resilient. Purchasing power is still there. People are still buying. The reason that people are buying for the most part is they're loading it up on credit cards. And we'll see in a couple slides later what credit card debt looks like in the US. But right now you can see what's happened with respect to household savings. Now, the other thing that you'll hear about is when they talk about, household savings or what people have, many times they're referring to the upper income levels, okay? And when you start moving into the top 1%, the top 10%, the top 20%, even the top 40, 50%, they do have some cash saved and stashed away. But if we look and see sort of what mainstream America is doing, most people don't have a lot of cash set aside. And that becomes problematic for a number of reasons. The old rule of thumb and the current rule of thumb is you want to have a minimum of 6 months living expenses stashed in liquid cash that you can easily access. And it's better to have 12 months. Right now, I'm a proponent of 12 months just because of the volatility that we are seeing in the markets and the potential for things to happen and potentially go a little bit sideways and squirrely on us. Next slide.
Lauren,
yeah, go ahead.
So if you look at there, to back there, the little green box here at the top, in the 70s, with the peak of that inflation, it says that the Americans were still saving nearly 15% of their income at that time.
Yes, exactly.
And that, we're saying, down here, it's 4.7%. So they're saving a third as much of their income as they were during the highest inflationary period in history.
Exactly. So talk about having the apple cart, go upside down. Could you imagine if they let inflation and started having the same measures in place that we saw back in the 70s, where people's savings, and that's best case that we're 1/3 of what people were saving back in the 70s. I would argue, just in having a pretty good look at what clients and people on average look at, that the savings isn't even at 4.7%. Okay, I personally believe it's much lower than that, but it's also, if you take a look at the overall economy, I would believe you're at about a 4.7. The next slide, this is credit card debt. Okay, and this is where the majority of the spending is coming from. Now, some of it is still was coming from stimulus money. That stimulus money that people were getting is long gone. Okay, way behind us and long. It's just, most people have spent that within the first week of getting it. So right now, I mean, you look at the price of eggs, you look at the price of household goods, you look at the price of most everything. Wages have not kept up with price increases that we're seeing. No. And so most people are having to put that deficit that they have on credit cards, which is why we're seeing that at the highest levels that we've seen in the history of the country. Okay, next slide. This is one that surprised me. This is one that I wasn't aware of, okay? But consumer credit, consumer loans, auto loans, credit cards, consumer finance loans, their delinquencies are at almost the highest they've ever been, okay? It's rivaling the levels that we saw back in 2008 right now, okay? That becomes a little bit unnerving. Now, I know that it sounds like a lot of this right now is doom and gloom, doom and gloom, doom and gloom, and it really truly is not. This is simply so that everybody has the data and the information so that when you're talking with clients, when you're talking with new home buyers, when you're talking with people that may need to list their homes, that you're in a position to give them very good information on what's happening in the markets and things that they need to be aware of so that they can also prepare themselves for what may lay ahead. Because I believe that part of our jobs are to be a consultant for our clients. And these are some things that I believe we have to be aware of as professionals. The consumer loans having challenges, though, that was something that was very surprising to me. And I've talked to a couple people. Randall, you and I know had a discussion on this at one point, what, 6 weeks ago, maybe 2 months ago, about a company that was doing repos, and talking about that. There's the numbers. Okay, that does bear that out for us to look at.
Yeah, we
Okay, so this
talked
is
to
something.
somebody who was repossessing 800 cars a week.
Yes, right. There it is. I mean, look at those numbers, right? It's again, the stimulus money is gone. Okay, wages have not been keeping pace. The sectors that are also that were hiring, hospitality was going gangbusters, which was why you were seeing some of the employment numbers looking very good. The last set of numbers that came out last week were down by 0.2%. That's a big drop. Okay, 0.2% doesn't seem like much to you and I, but 0.2% for employment to go down and unemployment and new claims jump up is a big deal. Hospitality was insulating a lot of that. Construction jobs, there's never been a bigger deficit and a faster decline in construction employment. And that construction employment numbers tend to be a leading indicator versus a lagging indicator. Okay, so most of the employment numbers that you hear about are lagging indicators, meaning that things have already happened and the employment numbers come down at the back of the bus. Construction spending or construction employment is a leading indicator because that industry feeds into so many different industries. The economists and people in the financial markets look at that one as a leading indicator for what's about to happen. Next slide. As a result of the failure with SVP over the weekend, the Fed, the Board of Governors, has an emergency meeting this morning at 11:30 a.m. This is unprecedented territory. Very rarely do we see these kinds of things happen. And what they're going to do is they're going to talk about the discount rate. That's what they're meeting about today. What do they do with the discount rate? Now, for those of you who may or may not know, there's a couple of different rates that get talked about right now. There's the discount rate. That's the rate that banks borrow from each other at. So if I'm a bank, pick your favorite bank or credit union, and you go to the discount window, that's where you're borrowing money from the Fed overnight, okay? The other rate that gets talked about is the prime rate, and those two rates are not the same. The prime rate is what you and I as consumers get and what our credit cards and auto loans and home equity lines of credit are tied to. And there's approximately a 3% spread or 300 basis point spread between the discount rate and prime rate. So this is something as a result of what's happened with SVB, sorry, I want to say SVP, with SVB that's got the Fed meeting, because as a result of the rate hikes that they've been having, it's put banks and some of them under a little bit of duress. So Randall, is everybody familiar with what actually happened to cause the failure of SVB?
So probably not. In fact, I'm not sure how many people are really aware of it. Here, I'll recap just quickly and then you can fill in. But basically, this bank, Silicon Valley Bank, is the 16th largest bank in America, and it collapsed. Was Friday, right? And
Yes.
the Feds came in. It's the second largest bank collapse in history after the savings and loan collapse back in 08. And it's kind of a big deal.
It is kind of a big deal. Will you go to the next slide?
Yep.
So SVB is a bank that was based in Silicon Valley, and SVB's business was basically investing and funding startups and venture capital, et cetera, et cetera. Okay, they were heavily into that area. The bank was very well capitalized as well. But what's happened as a result of the economic slowdown is that funding for VC has actually slowed down. So a lot of these companies that were startups
VC
and
is
that had,
venture
yeah,
capitalism.
sorry about that. So VC is venture capital. A lot of the companies that were using venture capital and that had been funded, or that were on the books for SVB, all of a sudden, because they were having a harder time raising money, had to go back to the bank, and they started to withdraw funds to meet capital requirements that they were having with their businesses, and also to meet payroll, et cetera. Well, then what happened is more of these more of these customers were going to the bank saying, I need some money. The bank then had to go raise some additional capital. Okay. What this bank had done is it had a fair amount, actually a substantial amount, that was invested, as most banks do, in treasuries. Okay. And so with those treasuries, it's a safe bet and it's a safe place to put your money, provided that you can hold that treasury or that bond until the expiration date of that bond. If you find yourself in a place right now where you have to go and sell that bond to liquidate or to raise capital, which is what the bank had to do, then you end up paying a significant discount to get that sold. Now, here's why. Let's say that I have a bond that's worth $10,000 and you purchased this back in 2021 and it was paying 3%. Okay. Now bonds, let's say, just for the sake of the argument and the illustration, that a bond, that same bond, if I were to buy it today, is paying 6%. Which bond would you rather have? Pay $10,000 for 6% or pay $10,000 for a 3% return?
Right.
The 6% return. So in order for me to sell that 3% bond that I'm holding, that I need to go raise capital with, I have to discount that bond. So now I'm selling you that bond that I paid $10,000 for at $8,000, $7,000, possibly $6,000. Okay, I've got to keep discounting that bond until you as the buyer say, that's a good deal for me now, I'll buy your bond at that discount. Well, what happened on, I think it was Thursday, Randall, is SVB had to post that they took like a $1.8 billion loss or write down as a result of these bond sales. And that's when investors went, okay, if there's one fly in the kitchen, are there more? And that's what started to cause that run on that bank. And that's what put them into financial trouble. And that's why the Fed came in and purchased them and shut them down.
So it's
Since
kind
that
of like
time,
It's a Wonderful Life, right? You remember that movie with Jimmy Stewart, and they're like the bank run. Everybody's lined up trying to get their money out of the bank. It's almost like an old school bank run.
it is, and believe it or not, they happen in today's world. So what the Fed did is they just came out over the weekend and they said that the bond prices that banks have and the bond holdings that banks have will be guaranteed. Okay, what the Fed also came out and said this morning, because they don't want to see a run on banks. That's the worst possible thing that could happen to the country and with the Federal Reserve, and they will at any cost try to avoid that from happening, because we also remember what happened back leading up to 2008. There was a run on some institutions as well. What they then came in and said was that depositors, even if you're above $250,000 per account, which this bank had many, many people that were very significant and large investors that had put money in there, not investing in it, but actually had money parked. The Fed has since come out and said this is not a bailout. So if you were an investor in the bank, right, it's a capital market, you invest in something you think is going to go up. Sometimes you win, sometimes you lose. They're not protecting the investors of the bank, but they have said that we will make sure that bondholders or people that actually had money there are all whole, and we are guaranteeing the value of bonds. So what they're doing is sending a message out to everybody else that says, hey, if you have these holdings in other banks, not to worry. They're liquid, they're safe. You will be liquid, you will be safe, everything will be okay. And that's what's happened in the last couple of days as a result of what's happened with SVB. And then since then, there were also two other banks that just recently failed over the weekend as well, that the FDC went in and took control over, and it happened for the same reasons that happened on SVB. Most of the banks out there right now have significant holdings in treasuries and bonds. Okay. And what it's called is, when you look at those, if I paid 10,000 for that and it was returning a 3% interest rate, and now a $10,000 bond is returning 6, those securities aren't what are called marked to market right now. Okay. And mark to market would mean that if I paid 10,000 for it at 3, but now I've got to discount it, so it's really worth $6,000 or $7,000. That's a hit on the balance sheet. And most of the large banks, most banks out there, if they were to go mark to market on these right now, Randall, you'd see a significant write down in the value of these banks. And that's why if you look on the markets today, you'll see that a lot of the mid-sized regional banks and smaller banks and bank stocks are under significant pressure because investors are worried about this right now. So the Fed's got a little bit of work ahead of them. I think they're going to do a good job on it because they have no alternative but to do a good job on this one.
My gold spiked upwards almost $100 an ounce, by the way, this weekend.
I'm sure it did, without question. No, absolutely. So what this has done as a result of this is, again, bonds are doing very, very, very well today. Okay. Again, mortgage-backed securities, we're having a rally right now. So if you've got clients who are out there thinking about locking, talk to them, have them talk to their lender about it. Now, with what's happening with the financial markets, it's even more important for homeowners and clients that you have that are purchasing to be very smart and very strategic in how they structure their financing. Right now, I'm seeing far too many clients being asked to pay discount points on rates when it's not necessary. And I don't believe that that client will see a break even on that discount point, because I fundamentally believe that inside the next 18 months, we're going to see a very strong reversal in mortgage rates and see a drop coming. And those clients at that point would have an opportunity to restructure that debt. But if they load it up with front end points right now, they won't be able to see that same return on the investment that they're wanting. Okay. This next slide, this shows you on average from the time the yield curve inverts, which when we talk about yield curve inversion, we're talking about the 2-year versus the 10-year. Okay. And when the yield on the 2-year bond is higher than the yield on the 10-year bond, that's called a yield curve inversion. And a yield curve inversion, almost without exception, predicts recession. That sounds like a tongue twister, not meant to be, but it literally is almost as sure a thing as a sure thing can be. On average, it's 15 months from inversion to recession. This slide actually shows that we did have a recession with COVID, although nobody fundamentally or publicly acknowledged that we did. And now, right now, everybody has been saying soft landing. The financial markets, if you look at the stock markets, you would argue that they were seeing that we weren't even going to have a recession by the bull rally that had happened over the last little bit. But if you look at the markets over the last couple of weeks right now, they've turned bear and the markets are declining, which would give you the impression and the indication that they fundamentally do believe that a recession is coming. Okay. Recession coming is not a bad thing. A recession coming, typically we have them on average about once every 10 years historically. And a recession becomes a reset for the economy. And two things traditionally happen when we hit a recession. Interest rates go down because the Fed has to pivot, and they usually pivot quickly because they've overcorrected on the upside. So you see interest rates come down, consumer interest rates come down, mortgage interest rates come down. And with the exception of 2008 and one other recession that we had, real estate values actually go up in recession because the affordability index goes up as a result of the interest rates coming down. And that is the financial markets in 30 seconds or 30 minutes or less, as brought to you by the Fed and the moves that they're making right now. Any questions?
Any questions? So I would capture Lauren's phone number, because right now it's not the time to have a run-of-the-mill loan officer. It's to have somebody who's really good. 801-550-0868. So 801-550-0868. And Lauren's always wonderful about answering questions. And I like him because he actually is able to help a lot of my clients and people that I work with that ordinarily would have a, how do we say this, a more difficult time getting financed. His non-traditional loans are amazing, actually probably the best that I've seen.
Well, thanks, Randall.
So thank you so much. And let me put this over here, and I'm going to pull up my slide here so that we can go from here, and I'm going to make it a little bit abbreviated here. And okay. So let me pop this up again and see if I can share the screen. All right. And there we go. Okay. So the power of context, standing out from the crowd. So we've talked about this. We're probably going to have this main theory in marketing is going to follow us throughout this year and maybe for the rest of our lives, but definitely this year. And that's about throwing a wider net, that we need to throw a wider net to do more and be better. And first of all, I want to say thank you to all of my agents, because it looks like a lot of you are working really hard and you're paying attention, because right now, when I look at equity real estate, I pulled up all the different brokerages, et cetera, and we've got brokerages that are 2 and 3 times as large as we are. We are some of the highest closing ratios in the company. And I think it's because, we do a better job at marketing and we focus on it. And we're probably some of the only agents or only brokerages that actually has marketing meetings on a weekly basis. And marketing is everything, because we're always selling ourselves. And thank you for those that are letting me see your faces too, because if I can see your face, it's always a little bit more engaging than it is, if I can't see your face. So let's talk about some different, types of marketing. Why is everybody emailing? We get a ton of spam emails, don't we? It's because it's easy to do, it's cheap, it's easily replicated, and you can automate it, right? And you can do a whole bunch at once, because when I'm sending a message out to equity or to my branch, I'm not going out there and going, okay, 183 times, I'm sending this email, sending this email, sending this email. Just like when we talk about this class that we're doing today, this mastermind, it is, I make one message and click and it goes out to everybody. So we can automate it. And it gives us some qualified leads. So you can do this, and I'm just going to touch on email because this isn't the main focus today. It's not our main thrust. But the idea is to get a qualified lead. If we send an email out saying, here's rates, are lower, they just dropped. Or here's what I've got. I've got a pocket listing, I've got something, whatever it is, whatever the message is. But we're trying to get a qualified lead. The qualified lead is somebody who's shown an interest in your products or services and has a higher likelihood of becoming a customer or a client. That is the goal for all of us in real estate, is to have as many people as we can become our clients. That's important. Now, the conversion rates for emails can be a little bit misleading, but if you look at this, there's 16 industries here. Over on the right, it's probably a little fuzzy, but they're saying the conversion rate by industry is 2.4%, okay, for emails. For real estate, that means out of every 100, you might get 2 or 2.5 people that would give you some type of a response in this case. The average conversion rates across all 14 industries about 2.9%. And according to a study, 67% of customers prefer self-service over speaking to a company representative. So typically, if they can do it online and avoid talking to you, they're going to do that. It's because they want more control of their buying journey. Forms provide users with convenience, etc. And so there's a lot you can do. And KV Core, if you're not spending at least 30 minutes a day on learning about the different things that it offers, you're making a big mistake, because there's so many different marketing tools in there that it is truly amazing. Now, those who fill out a form on an email or website, and KV Core, you can set up your own website. You can do a landing page, you can do a form, you can do all kinds of things there. But those who will actually fill a form in real estate, it's only 0.6%. I think these numbers are high, but this is what the national standard is by industry. 0.6%, so less than 1% are actually going to take action. And a lot of that is because calls fare better in real estate, personal contact. I can remember starting out in this business in Utah. I started out a long time ago. I did my first flip at like 15 years old, bought a car with the money I made from it, but in Oregon. But when I started out in Utah, I moved here in October of 04, quickly became the vice president of the Investor Association, then became president about 3 years later. And I can remember talking to all these different, agents and investors and people. Oh yeah, I've got this automated system. We're going to go online. We're going to do all this stuff. And I'd tell them, I'd say, this business is a face-to-face business. You're not going to survive if you're trying to do it all online. And all those guys that tried to do it all online actually failed and, left the business. because it's a face-to-face business. People want to contact with you, and all your marketing is designed to get you face-to-face with a client. So the call rate goes up a little bit, 1.7%. We have a little bit better response when calling, and that's because they can get better information from you. So I want to talk about the hierarchy of contacts in our marketing. All right. And this is the marketing, the best forms of marketing, and what you should be well aware of, so that when you're doing your marketing, when you're looking for new clients, people like Marco or, Julie or Mike or anybody else are going to be able to focus on what's going to give them the biggest bang for the buck. So the number one bang for your buck is face-to-face. Okay. Anytime you can get face-to-face with somebody. I close typically 90% of my face-to-face meetings. If you're not closing at least 70 or 80% starting out, we need to work on, some scripts, etc. And you probably need to set an appointment with me, and I'll try and help you go over what can help you be more effective. But number one, face-to-face. All marketing should be designed to get you this, a face-to-face meeting. Okay. Number two, on the phone. Okay. Where you're actually talking to somebody and you're making a connection with them. All right. And usually we don't have enough time to spend 500 hours each week on this, but we should be calling those top clients, those people that are in our top 10 or 20%, the top of our SOI, people that we've done business with, people who are most likely to do business with them. And so when I talk about, using the phone, don't mistake me. This is not cold calling. This is contacting people in your contact list. Okay. Cold calling sucks, and it works. Don't get me wrong. It works, but you're going to make, before the market shifted, it was about 400 calls to get a client at least. Okay. You'd make 400 cold calls and you get a client. Now, Alan Larson has worked with me and for me for years. And, he calls a lot. He's always pounded the phone. And he called me 2 weeks ago. And he says, Randall, he says, I am spending 120 hours cold calling to get one transaction now. So think about that. That's 8 hours a day for a freaking month. All right. So I would not suggest cold call. Unless you got nothing else to do, then it's great. Do that. But it's reaching out and making that personal connection, that personal engagement. Okay, number three, text. Text just don't get ignored. Somebody send me a text, I look at it. Now, if it's, it's all businessy, like Temu is I guess they would be the competitor to Amazon. They send me a lot of crap text. So I look at Temu, I see this stuff, and I just automatically delete it. But if you're smart, and we'll cover this a little bit, you're going to have an engaging message that's engaging right from the beginning. Number four, voicemail drops. People check their voicemails. Okay, I check my voicemails. I don't check my voicemails as often as I check my texting. And I'm kind of a slacker on this lately. The last week, I probably checked my voicemails every 2 or 3 days. And it's because, I figure people will text me, and I tell all my agents, text me. If you need me, text me, text me, text me, text me. But voicemail drops are very effective. Then you have video emails. All right. When we talk about video emails compared to regular emails, and there is a way to send video emails out of KV Core, or you can use BombBomb. I use BombBomb because it's a larger scale thing, but I like KV Core. It gives you a certain number free, and then you got to pay to upgrade. But video emails are between 73 and 83% more likely to get opened and listened to and engaged. Okay, engaged with. So now let's talk about, how do we make texting more effective? Okay, I have sent out maybe 500,000 texts, I would guess, over the last several years. One of the things we can do is, I'm going to tell you the one thing we do always, just because it's important and you shouldn't forget it, is we make sure that we have a very marketable message, something that's going to be interesting to people, right? Something that's going to get their attention, something that's going to say, hey, you want to look at this. Now, one of those things could be, did you know that the 16th largest bank in America failed on Thursday, and 2 more failed over the weekend? Well, I don't know who you are or who your clients are, but I can tell you, I would look at that. Most people would look at that, and then you can segue into something else. Like, this means that we're likely to see a better mortgage rate in the near future. Because Lauren said, hey, look, the mortgage rates dropped. They dropped by 0.25%, 0.5%, just over the weekend. That's a pretty fast drop. And it might be more today. So how do we make texting more effective? Well, number one, we have a compelling message. Number two, you can use pictures. All right. You can use pictures. Now, easy texting is where I've sent out probably 90%. And there's a couple others that I've used. It's about 2.5%. It's 5% 5 cents if I put a picture or something like a video in there. But you can look at this, and you can use what we've talked about in the past, which is where I take Snagit, I capture the picture, and then I can put a message in there. And you could put something like, does it feel like the market's going down faster than you can control, question mark, but put a picture in there. A picture conveys more than words, okay? And the retention rate is much higher. People will remember what they see, because a picture is like 1,000 words, right? And when you look at this is what I'm trying to convey to you as an agent. You're going to remember this. You want to work harder, or do you want to work smarter? Now, if you want to work harder, that's great. Sometimes we have to. But working smarter is always better than working harder, all right? You're going to remember that. Work harder, work smarter, okay? Pictures are fun. People like to look at things that are just fun. And what's more fun than a photo? Well, it's a very short video, right? And so, here we've got my little friend, the French bulldog, right? And everybody loves dogs and puppies, etc. And this is the dog that, I got to be honest, I clickbait on this all the time, because, they dress this dog up in different outfits, and he's going down, stairs, etc. Oh, there we go. There's the stairs. But it's engaging, okay? It's engaging, and you can put short videos of you, short videos of other things. You can use Snagit. I like Snagit. It's by TechSmith. You should all write that down. You should all buy that, because it is a way to amp your personal marketing, because you can capture videos, you can capture pictures, you can edit them, you can get rid of words, you can put your own words. There's a lot of things you can do that will increase your effectiveness. And so I might buy pictures from Big Stock, and then I'll adapt them to my own market. But videos are important. So the important thing here is we're going to go all the way back to Shakespeare, and people forget this, because people say, what do you think about this video, Randall? And they send me a 5-minute video. Shakespeare says brevity is the soul of wit, all right? That means that shorter is better, all right? Shoot for less than 30 seconds. It's important. And the reason we shoot for that is we want it to be fun and engaging. If you don't want to see it, chances are that nobody else will either. Always, always include a call to action. If you want your marketing efforts to have impact, you need to master the call to action, okay? Ask them to take some action that's going to benefit them, because everybody's favorite radio station is WIIFM. What's in it for me? Okay, that's important. So ask them to take that action, because simply a call to action is going to tell consumers what you want them to do. It's much better to ask them to do something and make them ask them in a way that makes them want to do it, click, get more information, etc. But the one thing they all do, that all calls to action do, is entice the consumer to take the next step in the buying or selling cycle. Now, you need to remember this, and this is a picture that you should remember. 60% of yours, and of course none of you are like this, but 60% of your presentations suck, okay? And here's why. according to Brian Tracy, Zig Ziglar, all of the marketing people, 2/3, 66% of all salespeople, real estate agents included, leave the appointment without asking for the sale, okay? Without asking for business. I don't know how many times I followed up after other agents. A guy will call me and say, hey, we're thinking about, selling a house. He's got my door hanger, postcard, ringless, voicemail or a text. And I've gone in there and in 15 minutes, I've signed him up, but I've got a client. I give him a quick pitch. Can I help you, achieve your dream, sell your house for the most money possible, etc. Click or find the dream house. And I hand them the contract and a pen, or I hand them my iPad and a pen they can digitally sign. All right. And I walk out. And sometimes when I'm walking out, I run into the other agents that have talked to them. And I'm saying, and usually I just make a point of saying, hey, can I help you? And they're like, who are you? And I'm like, well, I'm the agent that has this property, listed. I just put it under contract with the seller. And I get called some pretty interesting names sometimes, but SOB, it seems to be a favorite, but it's because their presentations suck. All right. They didn't ask, will you work with me? Can I help you now? Will you approve the paperwork? Okay. Can we get started listing your house? Can I help you find the house at the best price possible? Hand them a pen, hand them a contract, hand them whatever, but get them signed up. Ask, ask, ask. Because if you don't ask, what is the answer? The answer is always no, okay? The confused mind says no, and so does the mind where nobody asks them. They're not going to say, oh, that was a great presentation. Yeah, we want to use you. Because most agents, and I've listened to these for 15 years, well, if you need somebody to help you, let me know. That's really not a call to action. That is like so lukewarm. That's not it. We're not asking for business. Ask for business. ABC, always be closing. All right. You want to always be closing because you're the best person to help them. All right. Let's talk about voicemail drops. Okay. Because that's in the hierarchy. Remember, we talked about it: face-to-face, phone, text. Number 4, voicemail drops. All right. People listen to their voicemail in the same way almost that they see their text messages. So I listen to mine. Sometimes it's a day or two before I get to them. All right. We live in a post-caller ID world. So what do you do when you get a call from an unrecognized name or number? Okay. Or if it's an out-of-state number, etc. In fact, if you're like me or like most of us, you're probably going to ignore it or you're going to decline it. Right. In fact, according to studies, and I think this is like, Shake Mail said, 80% of calls end up going to voicemail. All right. A lot of those go to voicemail. So you call, nobody answers, it's going to voicemail, right? If you're calling your SOI, if you're calling your top 10%, leave a voicemail, but script that voicemail first. All right. Because these are some things that you can do. So let's talk about a voicemail drop. All right. At its simplest, a voicemail drop, also referred to as a pre-recorded voicemail, is literally dropping a pre-recorded message into somebody's voicemail inbox. Their phone doesn't ring, it never rings, but they do get a notification that they have a new message. All right. Now, Ring Cowboy, ringless voicemails, etc. You can do this on KV Core, another great tool that KV Core has. All right. Is you can drop a voicemail, ringless voicemails, all right? So why do you want to use it? Because it's effective, efficient, engaging, and can be enjoyable, all right? This is important. It's a time saver, all right? Instead of individually calling, these hundreds of numbers, waiting for, the call to go to voicemail, listening to the greeting, and then leaving your message, you can record a personalized message for the whole group of your SOI, or maybe you have 3 or 4 different groups. Maybe there's your 21 to 30 group and your 30 to 40 and 40 to 50, so on and so forth. Or they might be, I like one of my agents worked with this group on Rock Salt, which is a group of musicians here locally in Utah. You can have a special message that goes out to those guys. But you want to save those messages in your personal library, and the right message is always waiting to go, and use different ones. But it's great because if you do your homework and you know who your group is and who you're marketing to, you tailor that message to them specifically, okay? It's a message that is going to be really important. So for example, if I'm sending a message out to you guys as agents, I want to say, hey, how would you guys like to do 3 times the business and pay, 10% of the commissions that you're paying currently, or no commissions? Or I might say, if you're already my agent, I might say, how would you like to get, instead of, worrying about the $4.99, how would you like to pay no split to equity? Okay, well, I could probably do better than that if I think about it through, but no split equity. Well, of course, people don't want to pay the $4.99. Hey, Marco, how would you like to avoid paying the $4.99 to equity? Well, Randall, I think I'd like that. And putting words in his mouth, at least I'm getting a smile, out of him there. But basically, I'm going to tell you something, and I'll say, give me a call. Let me explain that to you. Let me show you how you can do that. And then he calls, and I tell him, well, here's what you do. You do what I do. So if I'm taking a listing, I take a listing for 6 or 7% or whatever my percentage is, plus a file fee. And I do it for the file fee of, $4.99. And that, $4.99 is paid for by the seller, or I've done it with the buyers or anything else. So that way I get 100% of my commission. And, that's happened over 800 times over the last few years. And you probably want to be that agent too and do the same thing. That's a message that people can relate to, right? So do your homework, know who you're talking to and what's going to motivate them, right? Perfect your message. You only get one chance to make a first impression, okay? With voicemail dropping, that's not entirely true because you have the luxury that isn't possible when you're leaving a phone message in real time or when you're speaking to a live being. You get to draft, revise, practice, record, delete, and repeat as often as you want until your message is exactly the one you want to leave, right? Exactly what you want it to be. And you record it and you save it and you get to use it. Less is more, okay? Keep your messages down under 30 seconds, all right? Ideally, videos that are 30% or 30 seconds or less are much better too. It's not the time for the full sales pitch, right? We're trying to get a response, not the sale right then. We're trying to get them to take a call to action. All right, we want to call them to action. Call now. Let me, call me to find out more. Call me to find out how to save money. Call me how to, get a discount. Call me how to get 3% interest rate, seller financing, right? Those kind of messages. Every second beyond 30 seconds, it decreases your chances of getting a response and connecting by 2%, okay? That's mailshake.com does that. They do a lot of different data searches. So aim for the sweet spot of like 17 to 29 seconds, all right? So remember that, less than 30 seconds. I know it's hard for people like me that like to talk, but you get a chance to do this, create something amazing, and make it in 30 seconds or less. All right. So there are a lot of tools on KV Core. You can send out video emails. You can do voicemail drops. You can send video texts and put pictures, etc. Or you can try somebody else. Like I don't care who you use, only that you use it. For texting, I like easy texting. You can Google it. There's probably some that might have better prices than others, but I like ones that I can use a picture on. I can use a video on. I can use, something that is going to engage those people. Ring Cowboy does it. KV Core does it. Keep it all in one house. I'm a big believer in keeping it simple. I've been sending out maybe as many as 10,000 texts a week. Probably not ideal for most of us as agents because we don't have those larger groups. But these are things that each one of you can do, and I'm happy to answer any questions on it, unless it's about KV Core. I don't want to answer how do I send a text message in KV Core because there's a video on it, and I'll get 180 of those questions, right? And there's plenty of videos saying this is how you send text messages. This is how you send a marketing message. This is how you do a voicemail drop. This is how you do, all of those kind of things. And so those are things that you guys can do. And then if you can't figure it out, I'll send you to one of my team members or myself if I know it. I rely heavily on my team, but The main thing is spread that net wide, make it big, toss it out there. Okay. Catch those fish, catch those clients. That net's got to be really big. And I've just given you some great tools. Okay. What have I done in the core here is I've provided some information on emails, but I've said, call your top 10 or 20% of your SOI, right? Set a goal to talk to a number of them, face to face and on the phone. Okay. Send texts out. I've told you how to make text more interesting and more engaging by putting pictures or video on those texts. All right. And I've talked about using voicemail drops, dropping a voicemail that you have scripted that has a special message from you to them that's engaging, that's less than 30 seconds, right? The sweet spot is 17 to 29 seconds, right? I've told you to do those things. And I've said ABC, always be closing, right? Always be closing. Don't leave the appointment without asking for their business. All right. Always, always do that. So important. There's things that I could have do better and I've done well, and that I've been really good at making the big kill initially. I did 82 transactions. My best year was 2019. But the stuff I'm telling you would triple that this year, just because 3-4 years ago. So 2019 is 4 years ago. We didn't have all the tools. We weren't doing, ringless voicemails. The text, you were limited. You couldn't send video text or pictures on text, et cetera. Those are things that you guys can do and take advantage of in your business. So show up for the Monday Masterminds, because we cover marketing every week. Tell your friends, we're happy to have them too. Any questions here? It's 10:02 and I want to be respectful of time. Thank you so much to Lauren Patterson, who gave the most engaging market update that I've heard. If you don't have a question, I'll see you all next week, and I wish you well. Go out there and close.
Thank you, Randall. Bye.
You bet, Mike. Have a great day.
Thank you, Randall, so much.
All right. Take care, Marco.
Thanks, Randall.
Thanks, Christina. Bye, guys.